order. Would staff like to do the roll call for me?
Yes, I will start us off with roll call. We'll start with you, Chair Rennie.
Here.
Director Givens.
Here.
Director White.
Here.
Director Abekoga.
Here.
Director Klein.
Here.
Thank you. And I will note that we currently have Director Mekachuk absent, but we do have a quorum.
Okay. And I'm trying to remember, we do not need to roll any kind of meeting videos, correct?
We are recording.
Yeah, no,
That's
I meant, what do you call it? How you behave in meetings and stuff. I'm doing that with a number of other organizations now, but we don't do that here. So we will, looks like the first thing we'll go to then is public comment on matters not on the agenda. Would any of our attendees wish to speak to us on matters not on the agenda? And you can raise your virtual hand if you're interested. Does not look like it. So we'll close the public comment for items not on the agenda and go to our consent calendar. Would somebody like to make a motion or ask questions about that?
I move approval of consent agenda. This is Hong Wei.
Second by Klein.
Okay, let me just double check. Would any members of the public wish to comment on items on the consent calendar? Don't see any hands being raised, so I'll close public comment. Would any members of the committee wish to comment on items on the consent calendar? Seeing none, I'll go ahead and call the question. Would staff like to do it or would you like me to do it?
I can do it.
Okay, go ahead.
Yep. Chair Rennie.
Aye.
Director Givens.
Aye.
Director White.
Aye.
Director Abekoga.
Aye.
Director Klein.
Aye.
Thank you. That motion carries with Director Mekachuk absent.
All right, that sounds good. Next up is item number 2 on our regular calendar, which is choosing a chair and vice chair for this Finance and Administration Committee for the next year. I can ask for a nomination or maybe just ask if anybody's interested in being chair.
I nominate Rob.
That's what I was afraid of.
I'll
Is anybody
second.
else?
Okay.
Okay.
Wait seconds.
All right, so we'll go ahead and call the question on that. I don't see, should I actually see if we need public comment on this? Let's see if anybody from the public wishes to comment. Don't see any raised hands. Close public comments. Any comments from the committee? Don't see any raised hands. I'll go ahead and ask staff to call the question on that one.
Yes. We'll start with Director Givens.
Aye.
Director Wei.
Aye.
Director Rennie.
Aye.
Director Abekoga.
Aye.
Director Klein.
Aye.
Thank you. And that motion carries with Director Mekachuk absent for Director Rennie to serve as our chair of the 2022 Finance and Administration Committee.
Okay, I'll pass myself the gavel. Next up, we need a vice chair. Would anybody wish to volunteer or would anybody like to draft somebody?
I'll nominate Hong Wei.
Are you okay with that, Hong Wei?
Sure. I'll be your backup.
Do I have a second?
Second.
Okay, so motion from Liz and second from Margaret. I'll just check with the public if they wish to comment at this time. Don't see any hands raised, so I'll close public comment and ask staff to do a roll call.
Yep. Thank you. Director Givens.
Aye.
Director Wei.
Aye.
Director Rennie.
Aye.
Director Abekoga.
Aye.
Director Klein.
Aye.
Thank you. And that motion carries with Director Mekachuk absent for Director Hong Wei to serve as vice chair of our 2022 Finance and Administration Committee.
All right, that sounds good. So we will close item number 2, move on to item number 3, which is Silicon Valley Clean Energy Investment Policy Update. And I'll turn it over to staff, probably Amrit.
Yeah, thanks, Rob. So good afternoon, committee members. Thank you for joining us. So if you remember, last December at our last Finance Committee meeting, we had mentioned that we were going to engage with PFM Asset Management as our investment manager. They would help us develop an investment policy and work with staff. So, and if you remember that we had done an RFP, and Jim Steele, who's also on the call here from Management Partners, has been helping us in this effort. Jim has extensive experience in this area, having served as City Director Finance for Palo Alto and other cities. So we, since then, that time, what we have done is we were able to execute our contract with PFM Asset Management. And so for today's meeting, what we wanted PFM to do was to walk through with the committee as to the next level of activity they're going to engage with the staff with, and give us some illustrative examples of how they may recommend modifications to our existing investment policy, and how some of the illustrative investment portfolios may look like. What will happen is that in June and July, we will work very closely, staff will work very closely with the PFM to develop a revision to our investment policy and an investment strategy that we expect to bring back to the Finance Committee in August. And once the Finance Committee concurs with the recommendations, it will go to the full board for approval, and then we will revise our investment policy and our investment strategy. Any questions on what this effort is about before I turn it over to Monique from PFM, or Jim, if you want to add anything to this?
I do, Amrit. Can you hear me?
Yeah.
Thank you for that introduction. I just wanted, just to correct for the record, I was budget manager and treasury manager for the city of Palo Alto for a number of years, and then finance director for the city of South San Francisco for 15 years. And I just wanted to reiterate, I was involved in the December meeting. I'm independent from PFM. I'm purely an advisory, supportive role to Amrit and his staff. I like to think I'm watching out for your interests. So that's what my role is. Other than that, I want to just make sure it's clear we don't have an investment policy to discuss and recommend yet. We wanted just to update the board on where we're at and some of the things we're going to look at. Thanks, Amrit.
Thank you. Thanks, Jim. Okay, we'll go to Monique then.
All right, good afternoon, everyone. It's a pleasure to meet you and have an opportunity to talk about this project with the committee. I'm going to share some materials just so you can walk along with me to get a sense of exactly what we'll be doing with staff and how we intend to present our recommendations, and more importantly, the outcomes and goals that we have associated with this project specifically. Amrit and Jim already shared that SVCE went through a request for qualification and interview process in 2021 and ultimately selected PFM Asset Management to be its partner. My name is Monique Spike, and I'll be serving as sort of the primary engagement manager on this project. And I come with a team of people with me who will be helping us do a number of things. So far, we have held a few meetings with Amrit and Jim and Kevin and Radhik as well to talk about the objectives and the goal of the project specifically, and how we intend to help to enhance the current investment program. What we expect to do is to review existing policies and historical data and ultimately use that information to prepare recommendations related to the investment policy, the allocation between the amount of cash that you should keep in liquid investments to pay sort of ongoing expenses, and the amount of cash that can be invested in longer term instruments to perhaps earn some additional income over time. We'll also be preparing investment recommendations for the investment strategy itself. Duration is one metric that we use, and duration is a measure of interest rate risk, which is particularly important in the current interest rate environment, where the Federal Reserve is expected to continue to increase interest rates through the end of this year and through 2023. So we'll be working with staff and with management partners through JIM to walk through the implications of that and what that will mean for the investment policy. We're also going to be talking about diversification strategies to mitigate risk. An important part of our relationship is the communication that we have with your staff and your consulting partners. That transparency and communication is a key component of the relationship. We want to ensure that we have the information necessary to provide recommendations, that we understand staff concerns, that we address any risk issues, so that when we come back to you with recommendations, your staff is fully comfortable with that recommendation and has felt they had enough information to walk through the associated risk and return objectives. Now, should SVCE ultimately decide to move in a different direction with regard to its current strategy, whether that be, for example, to have a portfolio of securities, I do want to reassure the committee that PFM Asset Management serves in the capacity as an investment advisor. And what that means is, for the investment program, we serve as a fiduciary for you. We manage the assets as though they are our assets. However, we never take control of the cash or assets. Your assets will be held by a third-party custodian under a separate contract between the organization and that custody bank. We will be, as PFM Asset Management, dealing in information, providing the investment advice, providing the trade execution details to your custodian. So that is an important point that we wanted to make. With that said, I wanted to go back and sort of just give you some context for the current investment program as it exists right now. Since 2016, the cash balances for your organization have grown at an annual rate of 41%. The high watermark is actually about $190 million. And that's a far cry from the very small balances that we started, or that you started with, back in 2016. Currently, all your assets are invested at the bank, at River City Bank specifically, with an average earnings rate of about 15 basis points. So currently, overnight liquidity earning about 15 basis points at the bank. Now, because the balances have grown so much, overnight investment vehicles may no longer be the best opportunity set, may not be the best choice, given just because of how much your balances have grown and how much cash you have available. And so what we really want to do is explore if a more diversified opportunity set can help you further protect your assets, still maintain liquidity for your operational needs, and maximize income, given where interest rates have trended over the last year and what's available in the market. Now, as a local agency in the state of California, you are restricted to a set of rules with regard to what you can invest in. And that permitted investment set is broader than where you're currently invested. What I have on the screen here is just a snapshot of the investment universe. And we have 4 major categories: conventional fixed income, broader fixed income, equities, and alternatives. Now, for your individual portfolios, things that you may be able to do on your own, you'd likely be in the broader fixed income, equities, for example, maybe even some alternative investments. But California local agencies like SVCE are limited to the conventional fixed income category. And within that category, we're actually further limited by the types of investments we can use and the maturity range of those investments. So I would say that California local agencies are limited in general to very high quality, short maturity, fixed income instruments. Those include government categories such as treasuries, Federal agencies such as Fannie Mae, Freddie Mac securities, which may sound familiar to you, municipal bonds that may be issued by the state or a school district in the state or a city in the state of California. Then you have credit instruments, things that are issued by corporations or banks. For example, negotiable certificates of deposit, commercial paper, medium-term corporate notes, asset-backed securities even. And so these are the types of investment classes that are limited to California agencies. In terms of maturity range, generally you're limited to investments with a maximum maturity of 5 years. There are some exceptions to that rule, which may require approval down the line, but in general, most of the time you're limited to investments that go out to about 5 years. And from a credit quality perspective, you're generally limited to securities which are investment grade and tap out at about an A- ratings level. So securities that are rated A- and above. So 3 general categories: high quality fixed income, 5 years and under, general A- rating and up. That's generally our investment set for California. When we took a look at similar agencies like Peninsula Clean Energy, we manage a portfolio for them, and the cities that house the residents and businesses that use your services, you can see that all of them permit government securities. So that would be your US Treasuries, your federal agencies, Fannie Mae, Freddie Mac, Federal Home Loan, municipal bonds as an example. And the permission of credit instruments, again, corporate notes, for example, it varies. Some do not. Some do with that A rating, which is allowed by the code. Some allow AA rated only, and some allow asset-backed securities and some do not. And for clarity, an asset-backed security is a security which may be secured by, say, for example, another type of receivable, whether that be credit card receipts, leases, car leases, etc. Now, the average duration, which is very close to average life, or the strategy on these portfolios varies. If you look down this list, you can see that some are extremely short with some overnight. Some are limited to 12 months, have a maximum maturity of 12 years, and some allow that sort of full gamut with a 1 to 5 or 1 to 3 year strategy. Now, a question you may ask is, why would these entities have different maturity ranges, different credit, if California government code allows you to use all of these vehicles? Well, the answer to that is that each of these agencies is very different. They have different size of their portfolios is different, their cash flow requirements are different, and their risk appetite is different. What our job will be with working with your staff and your consulting partner, management partners, will be to sort of evaluate where in this matrix does SVCE fit. You know, are you comfortable with credit instruments? Are you comfortable with asset-backed securities, for example? What maturity range makes the most sense given your cash flow needs and history? And we will be working with staff over time to come up with answers to those questions and an ultimate recommendation. Now, breaking that down into the individual component pieces of the project, the first step is the investment policy review. Now, what we'll be doing is working with your staff on a thorough review of the existing investment policy. Our recommendations for the investment policy will be discussed in detail with staff. And the goal for that is to ensure that our suggested changes and ultimate policy changes are consistent with SVCE's goals and risk tolerances. Your staff know the most about your cash flow needs, know the most about the history of the organization. We want to work with them to make sure that these changes and these recommendations are consistent. Another part of the goal will be to ensure that your policy is in compliance with the California Government Code. And we want to also incorporate any best practices that may exist. We have great organizations in the state of California. I'm going to quote the California Municipal Treasurers Association as one. There's also the Association of Public Treasurers of the United States and Canada, which give us a really good framework for mining best practices for investment policies. And while we're working on the policy, we want to make sure that your policy incorporates those best practices. In terms of an outcome, what you can expect is that your policy may have additional sections to the current policy. The goal is that those sections may provide for more comprehensive policies. We expect that the policy will detail procedures to reduce risk. For example, sections on safekeeping of the assets. So I talked again about the fact that we will never take custody of assets. They'll be held in third-party custody. That might be something we want to document in your investment policy. It may also mention procedures for internal controls and how performance may be measured on the portfolio should you decide to move in that direction. And lastly, we do expect to perhaps expand the list of authorized investments allowed by SVCE to a good number of the types that are permitted by the California Government Code. It's our expectation that we'll be working through these discussions with your staff for the next few months and bring these recommendations to the committee in August. The next portion of the project is the cash flow analysis. So I already spoke about how your cash balances have risen about 41% on average since May of 2016. We have a great cash flow model, which helps us evaluate the cash flow patterns of your program and identify what we call sort of seasonality and historical cash flow patterns. What we'll be doing is using that model to assess how much money is available to be invested in longer term securities. Now, we would define longer term securities as those with maturities greater than 1 year. And that will give us the information needed to provide recommendations and risk analysis for investments with maturities greater than 1 year, perhaps up to 3 years, perhaps up to 5 years, and see what impact that may have on the investment program. The goal for this study is to gain a better understanding of those historical balances, to get some additional detail from your staff on cash flow patterns in the future, and hopefully come up with an allocation that will maximize the efficiency of the program and the return potential of your assets. The final component of the initial project will be to help your staff understand the risks associated with a different investment strategy. As I mentioned now, currently all the assets are on deposit at the bank. And there are some benefits to that, and there are some risks to that. Should you decide to do something different, a portfolio of securities, for example, there are risks related to that. So our goal is to walk through what those risks may be. That includes credit risk, interest rate risk. Again, we are in a rising rate environment. What does that mean for return? Liquidity risks and cyber risks as well, something we're taking very seriously at PFM Asset Management. So the goal for that is to recommend a strategy that ultimately balances both the risk and the reward of the strategy. We also want to discuss appropriate investment benchmarks, essentially talk about how SVCE can hold us accountable and can hold the investment program itself accountable to its goals. We want to ensure that any program put in place has appropriate liquidity for SVCE. And lastly, again, appropriately communicate any cybersecurity enhancements to our program and relevant updates to staff as they come. Now, with all of that said, we wanted to give you a preview. And again, this does not reflect any current recommendation, but it gives you a snapshot of what this may ultimately look like. We put together some illustrative portfolios, and we did two types of portfolios. On the left, we did a sample government-only portfolio. So this portfolio only has government-style security types, treasuries, agencies, supranationals, which is sort of your supra government category, and municipal bonds. And on the right, we have a sample portfolio, which also includes credit instruments. So corporate notes, commercial paper, perhaps, and some asset-backed securities. Now, both of these portfolios have similar duration, similar average life of about 2.68 years. The gross yield on the portfolios range from 2.7% for the government-only portfolio to 2.9%, which has the addition of credit. And these portfolios were built about May 12th. So slight change in rate since then, but essentially just about in the same range. Now, the benchmark for these two portfolios is the current earnings rate on the bank deposits, which is about 15 basis points. So what this shows you is that with that government-only portfolio, the annual income difference, so this is the difference between earning 15 basis points in your current investment and earning 2.7% in a portfolio, is about 3.18 million on the government-only portfolio. And the difference between earning 2.9 million in the corporate portfolio and 15 basis points at the bank is about 3.4 million in annual investment earnings. So this is the amount of earnings that you would expect to receive from these portfolios every year. And we assume that there was about $125 million invested in this portfolio, which left some cash available in the bank for liquidity needs. So this is a snapshot of sort of the income potential of this project and sort of the quantifiable output, right? Sort of the fiscal impact of a project like this. We're talking 3.1 to 3.4 in annual income earnings. Now, the other side of this, of course, is the risk side. And right now in a rising interest rate environment, we're certainly getting a lot of questions from our clients about like, what does it mean to start investing in a rising rate environment? Well, the next slide, we show sort of composite returns. And this is PFM Asset Management's composite. It shows our 1 to 3 year fixed income composite on the top and the 1 to 5 year fixed income composite on the bottom. And I'll tell you all what a composite is. Now, these composites represent all of the portfolios, and I'm going to use the 1 to 3 as an example because it's at the top, it's the top line here. All of the portfolios, all of the accounts that we manage at PFM Asset Management that have a mandate to invest between 1 and 3 years. And so it allows us to show sort of the average across all those accounts. We're not picking one out to be specific or picking, another one out to tell a very specific story. This is across the entire company, west to east. And what's interesting, and I'll use the first calendar quarter of 2022, and if any of you have 401ks, stock portfolios, you know that the quarter ending March 31st was a very, very hard quarter. In the fixed income markets, the quarter returned negative 2.1%. Now that's a 3-month number. It is the worst performance in the fixed income markets, I think, in 40 years. Now, why is that? That's because interest rates rose so much between December 31st and March 31st. And so when we talk about risk, one of the things we'll be talking about is what that means for market values over the next few quarters as interest rates rise, and what that ultimately means for reporting purposes. Now, as you saw on the prior page, there's still some income to be had, and that income difference is significant given where you're currently invested. And that may be enough to compensate for the negative returns in terms of market value changes for the portfolio. But this is something that we really want to dive into detail with your staff. So then again, when we come back to you, you have a very clear picture and your staff has a very clear picture of what the risks are compared to a sort of liquid vehicle strategy. Jim, I see you have a question or a comment.
Yes, I do. And just to add to that, and Monique, correct me if I'm wrong, when you show a negative return, that's on the market value of the portfolio. Agencies like SVCE typically hold their investments to maturity. So they very rarely need to sell sell securities. So they don't actually take a loss. So Monique, did I say that right?
Yeah, I would say, Jim, I'd sort of hedge that a little bit by saying there may be reasons to take a loss on a security, and I'll give you a good example of that. 2 years ago, we were purchasing securities that were earning 25 basis points because that was the market available. And then today, the 2-year treasury is much higher. So there's a story where we may want to sell that security that was paying 25 basis points and reinvest in a security today that's paying 2.6%. And you may have to sell that 25 basis point security at a loss, but the income earned on the new security is going to compensate for that. You are correct in that this negative number does include a large market value change. And market value is sort of the price return on the security, and that's simply a function of where interest rates are. There's nothing to do about that. And this past quarter, the price change was so negative that it overcame all of the income earned. But to Jim's point, it's not necessarily a real number. It's only real if the securities, all of them were sold on March 31st. For the most part, all the securities in the portfolio, save a very small percentage for rebalancing purposes, are held in the portfolio. So what we're telling all of our clients right now is that this is a transitory period. As rates rise, you'll see price declines, but eventually that rising rate activity will subside and we'll get back to sort of an even kill. In your circumstances, we're going to be having a lot of conversations about income because that income story is very compelling given what you're earning now and what's available in the market. And to Jim's point, these market value changes aren't necessarily going to be a big part of your story because you're starting primarily from cash. Did that help clarify, Jim?
Yes, thank you very much.
Great. Amrit, I see you have a question here.
It's just a quick question. So the return you're showing here, the negative 2.21, this is the mark-to-market value of the portfolio, but it's not inclusive of the income. Or is it inclusive?
It is inclusive.
Oh, okay.
So this is a total return presentation, which is compliance with global investment performance standards. And you want to show total return because it gives you the full picture of an investment story. Total return is the sum of income return on a portfolio and price return on a portfolio. And the first calendar quarter of 2022 was, as I said, the worst quarter in 40 years because the income earned for the first 3 months of the calendar year was simply not enough income to compensate from the huge price decline in the market because rates rose so fast between December 31st and March 31st. And the reason for that huge rate increase is that the market's expectation for Fed action changed from expecting the Fed to raise interest rates 3 times this year to expecting the Fed to raise interest rates 7 times this year. So with that change in expectations, interest rates shot up. There was volatility in the stock market as a result, and we're still sort of dealing with some of that today. I also know that the market also expects another 3 rate increases in 2023. Any other questions on these first few slides? The last slide we have is a little bit of a calendar to keep the committee sort of abreast of how we're going to be working with your staff. I mentioned a few times that this is an ongoing project with staff. It's going to take a few months. We have a set of formal meetings on the calendar, but certainly do expect to sort of be talking outside of these meetings. On June 1st, we have our cash flow discussion. On June 14th, we're going to be doing a deep dive on the investment policy. On July 13th, we're going to start speaking to the investment strategy. And on July 20th, we have a second investment strategy discussion. It is our plan to come back to the Finance and Administration Committee in August to review those investment policy and strategy recommendations and seek your approval. And then in August or September, go to the broader board to review those policy and strategy recommendations that you had an opportunity to opine on. That is my last formal slide. I know in your materials there's an appendix. I'm happy to answer any questions. All right, I see raised hands. And
Looks like you have a
Director-
couple
Yep.
questions. Do you want to take questions at this point?
Yes, absolutely. Director Gibbons.
Thank you. Not sure how, in the sequence of things, these questions fit in, but I'll put them out there and then you can figure, let us know. From a city perspective, most of our cities have reserves, which are invested differently than others. We have an economic fluctuation reserve. We have a PERS benefits reserve, and we have one other natural disaster kind of reserve. And each one is identified and funded separately from the general fund money. And the reason I'm bringing that up is we have different kinds of cash flows. We have our cash that comes in from our income. We have our reserves that are policy driven to have a reserve amount. Then we have, I'm going to call it an account for programs. And then we might have some other accounts that I'm not thinking of, but we have, I'm going to say, different types of cash needs and risks for different types of cash. My first question is, does that figure into any of your recommendations, or am I overdoing it?
No, that's actually a great question. So I'll sort of break it down, and then I'll let Jim from Management Partners opine from his experience. But what we typically see is that we take a pooled investment approach, where we're pooling all your funds for the purposes of investment. And the accounting for each of those accounts is done sort of by the accounting team to make sure they're accounted for correctly. But the investments themselves are taken as a pool. Now, we will work very closely with staff to understand any cash flow implications that may be important and relevant for the structure of the ultimate portfolio we'll be recommending. But I think sort of the base answer to your question is, from an investment perspective, it's a pooled investment approach, and the accounting will ensure that each of those individual accounts are accounted for separately and appropriately.
So just to carry through on that thought, for example, your pooled investment might have a split of 1 year at 10%, 3 year at 20%, 5 year at 40%, and the rest, I don't know, overnight or 30 days.
Yep.
And that kind of, whatever recommendation would account for cash flow.
Exactly.
Okay, that was helpful, thanks. And then my second question is, you mentioned investing in bonds. I would assume there would be a policy that bonds from individual cities in our territory or from other CCAs that we're involved with, and any projects that we're involved with would be excluded.
I mean, that's certainly a consideration. I will note that to discuss that further with staff. Typically, we see sort of broad investment authority for municipal bonds in the state of California. So the California Government Code allows you to invest in all local agency debt in the state of California. But if there's a sort of a risk reason for not exposing yourself to the cities that you serve, then that's certainly something we would discuss with staff for the purposes of the policy.
Yeah, I would think that that would be important also for conflict of interest. I'm assuming that you make the decision, your company makes the decision for the purchase, and we have no say in the selection of what to invest in.
Yeah, I would say, Director Gibbons, that the investment policy serves as a guardrail for the investment advisor. So we would use your investment policy as strict rules as to what we can and cannot invest in. And so if there's an explicit instruction or explicit exclusion in that list, then we would not break the bounds of that policy.
So I would recommend that we staff spend some time on that. Also, I don't think this comes into play, but it might just be aware of the Form 700s that all board members and many staff have to sign. So,
And just for your information, Director Gibbons, we also sign and provide that Form 700 to many of our asset management clients.
so that's, excuse me, that's a significant consideration, I think.
Right.
Thank
You're welcome. Thank you, Director Gibbons. Director Way?
Okay, my question is, I know you work closely with our staff, so you understand the liquidity and how much asset can be used, but after initial discussion and policy making, how often do you come back to consult with staff to revisit it? Because eventually maybe there's a big investment coming up, might have to change some strategies. What's your timeline after the initial?
Yeah, that's another great question. We have a very high touch, what I call high touch relationship philosophy at PFM Asset Management. We have formal meetings with our clients on a quarterly basis to formally review the strategy, talk about any changes that we need to be aware of, just checking in and making sure the strategy sort of stays on track. We have annual sort of overall reviews where we update the policy, take another look at the cash flow analysis, and then we're also just generally available to our partners.
Okay, thank you.
Thank you, Director Ray. Chair Rennie?
Yeah, so I'm trying to think through my head what a policy looks like versus what, how often you said it was guardrails, and sort of more specifically, I think about there's kind of a 2x2 matrix of rising interest rates or lowering interest rates, and then the second dimension on that 2x2 matrix is increasing electricity prices or decreasing electricity prices. Decreasing prices increase liquidity risk. So that those are the two of your 4 risk items, I think, that can move around quite a bit and affect how you think. And where you sit in this quadrant, in my mind, is going to point you at what your duration target should be. And so I'm trying to figure out, are we going to create a policy that says something about like a matrix like that? Or are we just going to create a policy that says it's up to you to recommend, when we're in whatever quadrant, what we should do?
Yeah, that's a great sort of discussion pathway to take. So I think about it 2 ways. The investment policy should be very specific to what you're not comfortable with. And what I mean by that is, if we had the sort of utopian investment environment, doesn't matter, you wouldn't invest in this anyway, because it's just outside of your risk tolerance, period. And so those are the types of investment instruments that should not be an allowable option for the program. So I think of the investment policy as sort of the tools that we have available, and there should be nothing in there that you're ultimately not comfortable holding at any given time. Now, the investment strategy is where we look at what's going on in the market. We look at sort of cash flow. We have a view on, for example, whether credits are good to buy right now. Even if they're allowed, do we like buying them for one reason or another? Do we want to be a little bit shorter than our target maturity because we know interest rates are rising and we want to have some more liquidity? And then there's other considerations for strategy, and that's sort of necessity. Is there a cash flow need that we know is coming and we have to sort of shift where we were going and pivot to meet cash flow needs? And so those are the things that are interchangeable, and that's what we're going to be discussing with your staff on an ongoing basis. We'll be talking to them about our views on the market, where there's opportunity, what we're executing on, and then that sort of pivot information. Is there something we should know that's changing what we need to be doing? But your policy is different. Your policy document is, either I'm comfortable having this as an option, or I'm not comfortable and it shouldn't be in our policy, because there's no circumstance where we like that or would be comfortable investing in that. Does that help answer that question?
It starts to, again, my thought is, let's say we're in an environment where interest rates are falling and electricity prices are rising. So that says go as long as you can, kind of thing. And so our policy at that point says, if we're in that kind of environment, we really don't want you to go any longer than X. That's just beyond that is just really overdoing it. And then we have the opposite, right? Where now we really want to be short, and where's the comfort on how short we could be, also as part of a policy. Does it mean we sell stuff to get short? I don't know what all the extremes you could go to, but I think that's what you're saying. And those are sort of the bounds that we need to think about. But in my mind, it's thinking about it in terms of where we are on this risk matrix, right? If we say we don't want to go more than X risky, that's going to depend on where we sit in that matrix, to me.
Yeah, and I would say, Director Rennie, that that's not the information that's going to be in the policy. That's the discussion that's going to be had with regard to the strategy on the initial basis and on an ongoing basis, because the investment environment is going to change, the economic environment is going to change, and that's why we're meeting with your staff on a quarterly basis.
Okay, thank you.
Any other questions? I see no other hands raised. Oh, I see one. Jim.
And just to clarify, if OMRIT determines that, you all had a duration target of, making this up, 2.3 years, if the energy market, if your contracts, if those types of things change in a way that you hadn't anticipated and your cash flow needs change, he's going to be talking to Monique and her staff, and they're going to be looking at strategies for how to deal with that. If they need more cash, what are some options to deal with that? What should we do on future investments? And ultimately as well, all your funds are not going to be invested. You're going to have a sizable amount in, for example, the state investment pool, which are immediately available. So that provides you some cushion, so to speak, if things go in a way that you hadn't anticipated. But just to reiterate, Amrit and Monique and her team are going to be in communication more than just once a quarter.
Thank you, Jim. Any other questions for me? Okay, Amrit, I'll turn it back over to you.
Great, thank you, Monique. Thanks for the great discussion. Yeah, so as Jim mentioned, related to the next item is the stress test. Part of the stress test is also to determine the level of reserves we need to hold. And that also ties into how much funds we want to keep in a liquid asset. So all of that will be ongoing work that we want to make sure that we have sufficient reserves readily available should any of those contingency events were to transpire. So those are the type of discussions we're going to engage with Monique on. So I'll turn it back over to Chair Rennie.
Okay, we should open public comment on this item. I don't think we've done that. So let me open public comment. And I don't see any hands raised. So I'll close public comment. And before we close this item, are there any other comments from our committee members? Not seeing any hands. So let's go ahead and close this item and move on to stress test.
Okay, so there's two parts to the stress test. One we're going to discuss now, and the other we're going to discuss in a closed session that has to deal with threats to public services and facilities. So we'll go to the next slide, Andrea. So the purpose today is to go through the findings of the analysis. And the way I'll go about is I'll talk about how we constructed the test cases, what we were expecting when we constructed the stress test, and the results that we got. And then I'll go into a little bit of detail to the drivers of the biggest financial risk to us. I'll go through it a bit slowly, but it's very important to understand those drivers because it's very fundamental to our business model as we currently have it set. So that's sort of the way I'm proposing to go through the presentation. With that, we'll go to the next slide. So stress tests. So the way to think about these are extreme but plausible scenarios that if they were to occur, they could quickly deplete our reserves and make us uncompetitive. And what do I mean by extreme? So for example, when we're looking at price scenarios, we set our price scenarios at a 1 percentile level based on current levels. So what that means is that there's only, based on current expectations where the market is, there's less than 1% chance the prices could be even lower than what we modeled at for the stress test cases. But nevertheless, as I'll show in the presentation, those prices are not that far off. They're very plausible because that's where the prices were trading as recently as 12 months ago. And we've seen scenarios like this happen in our commodity business where prices go up steadily, increases very rapidly, and can turn around and collapse very quickly. So that's sort of the way to think about stress tests. And the reason we're doing is obviously to ensure that we have adequate reserves. We're planning for adequate reserves, and we have the organizational resiliency should one of these events were to transpire. It also helps guide development of our strategic plan, and it will help shape our 22-23 budget. So what we will do, and I'll talk more about this later, is we'll take one of these test cases that we've modeled, and we'll say, let's use this to set a reserve target such that we can withstand this stress event at a certain level. And that will dictate, that will help us establish what our reserve target should be for the upcoming fiscal year. And based on the reserve target we select, then that will determine what additional discretionary funds we have available for either providing additional discounts to customers or funding other services like our programs, decarbonization programs efforts. So the purpose today is to go through the scenarios, and then what will happen in June, as we do every year. In June, we talk about the strategic framework of the upcoming budget year. We discuss that with the executive committee. And then in August, in July, we have a recess month where there's no board meetings. But in August, very early in the August is the next finance committee meeting. We'll present the budget analysis to the finance committee. And then we'll take your recommendations, present the findings to the board in August for adoption of budget in September. Okay, so that's sort of the next steps. And the stress tests I'm presenting today, we've discussed it with the risk committee earlier this month. We're discussing it with the executive committee tomorrow. And then we're discussing it with the board in the next upcoming June meeting. So very quickly, there are 5 scenarios that we modeled. The first one has to do with what if prices were to drop significantly. What that means is the PCIA charges will be higher and PG&E's rate that we peg our rate to will be lower. The second scenario deals with insufficient financial liquidity. What happens if price collapse triggers a credit downgrade? What if we have increased collateral calls from counterparties in the California ISO? What I mean by collateral calls is in our energy contracts, for most short-term contracts over 5 years, with the exception of long-term contracts, as a credit risk management mechanism, we either counterparties post collateral to us or we post collateral. So counterparties will usually give us a credit limit. And once our exposure exceeds that credit limit, we are required to post collateral. And this would happen in a price, if prices were to come down, because then the counterparty's credit risk to us increases. And in those situations, we would be required to post collateral. So that could be a significant draw from our cash reserves. It's not a realized cost yet. Nevertheless, it's a big draw on cash. The third item here on scenario number 2 is increase financial security requirement for the provider of last resort. So what do I mean by that? So currently, PG&E for our area is the provider of last resort. What that means is if a CCA were to fail, to make sure the customers continue to receive uninterrupted services, those customers would go back to PG&E, and PG&E would make sure the customer services are maintained. So they are known as provider of last resort. And what they, in return for that, for being a provider of last resort, they're asking, and currently we post a financial security requirement. The current methodology so far has resulted in posting a very minimum amount of $147,000, but there's discussions at the PUC that's going to change this requirement, potentially change it. And there's some proposals that seems to be gaining traction that requirement could be that we post for 2 months of cost of serving customers in the 2 highest months, which for us could be as high as $70 million. That's a huge amount of cash. We're hoping that we're working hard to shape that regulation to make sure that that doesn't take shape in that form, working with CalCCA. But nevertheless, that's a risk, and we're modeling that. In our price collapse scenario, we're modeling that not at 70 million, at 35 million, because if prices would come down, the posting requirement would be lower. Okay. The third scenario is, what if our PPAs were to default, renegotiate for higher prices, or delay the commercial start dates? There's 2 dimensions that can pose problem for us. One is, if we don't meet our RPS target, there could be substantial non-compliance penalty. The other is obviously replacing the power at higher market prices. So that's a scenario we modeled. The fourth one has to do with load loss. What if we were to lose load to direct access or distributed energy resources, distributed load? What we model for this scenario is, what if we were to lose 10% in 2025 and another 10% in 2027? Obviously, load loss is not, it can be costly to us, especially not just the foregone revenues and operating margin we'll lose, but we could be stuck with stranded cost. In other words, the power we've procured on behalf of those customers, and if prices were to collapse and we have to sell that power in the open market, we could have a huge loss for the remaining customers. So that's not to be desired. The fifth one, as I mentioned, we'll discuss in the closed session. And the way we came up with the stress test is we brainstormed as an agency in all the cross-functional teams, and we said, what are the key strategic risks facing our organization? And that's how we came up with these stress tests. These are not the only stress cases, as I mentioned in the staff report and in the appendix to this presentation. There could have been other areas we could have focused on, such as business continuity, operational risk, natural disasters, and some of those areas we may focus on in the future stress test analysis. We expect to do this around this time frame every year, and if circumstances warrant, even frequently, such as we did last year when we saw that PG&E rates were changing substantially. Okay, we'll go to the next slide, Andrea, please. So at a summary level, I want to go through what we were expecting versus what we found. What we found is the biggest impact is our sensitivity to market prices. Our revenues are very sensitive to market prices, our prices. And the reason is because we link our revenues to PG&E, PCIA rates, and movement in market prices moves PCIA and PG&E rates. And this risk factor basically overwhelms all other risk factors. And this is the key risk for us. because our revenues vary so much because of the links to PCI and PG&E generate to market prices. And I'm going to go through in detail on this point. So the first scenario where we said, okay, prices were to collapse, we would have significant reduction in revenues and large drawn reserves. The results were same as expected. And this is similar to the stress test we did last in November that we presented at the special meeting of the Finance Committee. The second scenario, the price collapse that leads to insufficient liquidity, we found that the collateral posting requirements actually currently does not pose a significant liquidity risk for us. Part of that reason is long-term PPAs, we don't have posting requirements the way those contracts are structured. And some of our near-term larger counterparties, we've placed them in the lockbox in return for asking that we don't have any posting requirements. So we're actively managing our posting requirements through lockbox. But the polar requirement that I talked about does have a significant risk, and we modeled that at 35 million. Okay. The third risk, the PPA's default, delay, or renegotiate for higher prices, this on its own is a costly outcome. It can model that on an expected basis, or if prices were to increase and we have to replace the cost at higher prices, in 2026, for example, it could cost us 80 million. But for the stress case, this was not a stressful event, even though it's not a desired event, and we're going to do everything to make sure our counterparties perform for their contractual obligations. But for the stress test analysis, what happens is the PPA's default, again, the stressful scenario would be you have to replace at higher market prices, so prices go up. But because of what I talked about, the revenues, when prices goes up, our revenues increase orders of magnitude more than our replacement cost. So that actually on a scenario basis looks even better. So the results that we showed, actually, we do not model this for price increase scenario. We kept it at a price decrease scenario. And even then, the results are better than the first stress case. So again, not a desired outcome, something we will actively work to manage the risk, but not a huge strategic risk given the other risk driver, which is overwhelming all these other risk factors. The fourth one, the load loss, same thing, not desired on an expected basis, is costly if it were to happen. For example, in 2025, it costs 8 million. By end of 2027, it costs us 32 million on an expected basis. But on a price collapse scenario, because remember, we're concerned about we contract for power for our load, a load goes away, and we're left with stranded assets that we have to dispose at a time when market prices collapse. But what happens with this scenario is the price collapse actually helps with the load loss because we are in negative margin, so we don't have to sell power at a loss. So as model, the scenario looks better than scenario one because now we don't have to serve a larger load at a operating loss. So again, a risk we don't want to materialize. We want to do all our efforts to retain and attract customers, which we will do on an expected basis. It's costly, but not an extreme strategic high-level risk level, which right now is all about sensitivity of our revenues to market prices. So in the next slides, I'm going to go through in a bit of detail. Some of this may be very familiar to you, but it's a very important concept in understanding our business model. So we'll go to the next slide. Thank you. So as you know, we set our rates relative to PG&E's generation rate, our generation rate. So the standard graph we use on the left side of the slide here, we have a board designated discount level relative to PG&E's rate that we try to maintain, which is currently 1%. So that our customers are better off being with us for a number of reasons, one of them being getting power at a 1% discount to PG&E. Okay, so to do that, we also offset the PCIA charge because this is a charge they pay PG&E for being a CCA customer. PCIA, again, is all the legacy contracts that PG&E contracted when the customers were part of PG&E. And now, and they were contracted at very high, some of them very high prices. And now PG&E is saying, well, we made that obligation on behalf of your customers. They should pay the above market cost of those contracts. So they charge our customers a PCIA charge. So if you look at this graph, if PCIA were to be bigger, the orange box goes bigger, we have to shrink our rate, which means our revenues go down. Or if the PG&E, the black solid line, comes down, we have to shrink the blue box to generate, so our revenues would go down. So that's what we're concerned about, right? PCIA going up, PG&E generate going down, brings our revenues down. In the next slide, we'll talk about movement of PCIA and PG&E generate relative to market prices. So PCIA, and I've got some formulas here. These are very high level formulas just to illustrate the concepts, but I'll speak to it rather than go to the formula. Is that PCIA and similarly PG&E's generation rate is based on a forecast of market prices at the time the rates are set, and a balancing account that's based on the deviations from the actual realized prices to that forecast that it was used to set the rate. So for example, earlier this year, the new PG&E rate and PCIA rates went into effect in March, right? So the CPUC set a market price benchmark based on forward market prices as to what 2022 prices would look like. But if 2022 prices deviate from the actual, they track that in the balancing account. So that's why this is a critical point, is if we have a good year, such as we're having now, we can't fully bank on those reserves or on those dollars. Because if prices deviate from the forecast that was used to set rates, then that will be trued up in the following year. And in the following year, for us, that means it will be reflected in our revenues, either positively or negatively. So there's uncertainty in current year's margin based on what will happen with actual and forecast prices. So that's one impact. And then the other is the forecast prices that are used. So this 2023 prices, sometime PG&E will come up with an error forecast very soon. Right now, it will be trued up sometime in November, where they will use a current market prices to project what their rates will be in 2023, and that will be based on what they think the balance will be, the balancing account, plus what the forecast is for prices for next year that will affect their cost on the generation side and on the PCIA side. Okay. Any questions on this slide? There's a lot on this, but just want to make sure the concepts are clear. Okay, if not, we'll move to the next one. So the key takeaway from this is the box I circled in red there. Is that our revenues depend on 1 year's revenue, and this is why in budgeting, in the risk committee, we're starting to show 2 years of budget projections. If the revenues depend on 2 years' prices, so in 2022's realized price versus the forecast price, and 2023's forecast price. So if 2022 prices, actual realized prices are lower, and 2023 forward curves are lower, then PCIA will be higher, PG&E's generation rate will be lower, and our revenues will be lower. The flip side of that is if 2020 realized prices are higher, based on what the market is right now, we're in this quadrant. Seems to be we're going to be in this quadrant, so it's going to indications that we'll have a good year. So 2022 prices are higher, in 2023 prices are higher, then our revenues increase. And the other two boxes are shaded because the impact is somewhat unknown. And those are very unlikely scenarios, because if 2022 prices goes up, 2023 prices tend to go up too, because the prices, near-term prices, are very well correlated. So the key here is we face biggest risk from a price collapse scenario. And normally what would happen is if prices would collapse, we would benefit from a lower procurement cost, right? But the key point here is because of our hedging strategy, our power procurement costs are locked in. So we don't get to realize the commensurate savings on the power procurement side because of locked in prices, but our revenues drop significantly, for which we have no control over. We're very sensitive to these market prices. And that's something we need to plan for.
Amrit, could I interrupt for just a second? Brian has arrived. If somebody could move him to panelist, please. Thanks. Go ahead.
Okay. All right, we'll go to the next slide. So I just want to talk a little bit about the stress prices that we use. You know, I mentioned earlier that we modeled at a 1 percentile level. This chart here on the where it says past shows how quickly prices have risen up. You know, this is extreme case of run up, and most of the increases occurred in the 12 months. And on the right, in the future here, 1 percentile, it says 1% is 1 percentile prices that we've modeled. You can see that they were not that far off where they were 12 months ago. So this is my point. Even though we call it extreme, it's a 1 percentile level, but it's plausible. And we have seen this scenario play before. For example that I had mentioned before, in 2008 financial liquidity crisis, we had seen oil prices quickly go up to $100 a barrel. And within a matter of months, we had the financial collapse. Lehman Brothers went down. We went into that Great Recession, and prices tanked. Within two to 3 months, they came down significantly. If that were to happen, then that would be very catastrophic for us. So again, history doesn't always repeat itself the same way, but one thing we know is prices are volatile, and we need to be prepared for the volatility we face in our business, and especially the way our business model is right now. So we'll go to the next slide. So here I'm showing the base case, and with a lot of caveats that I wanna mention. So right now the prices are very high. So if I take the high prices and model our portfolio out to 5 years, the results look very good. Okay, so these are calendar year basis, not fiscal year basis. We're showing at the time, these were done earlier in the year, around the time we did the mid-year budget prices. Prices since then have gone up actually more. These results would be even better now. So what this is saying, if the current forward prices were to prevail and all the other assumptions that we have were to prevail, we will be in a very good financial position over the next 5 years. It comes with a lot of caveats. The big uncertainty for us is how PCIA and PG&E's generation portfolio will behave for the reasons I mentioned earlier. PCIA, PG&E's generation rate, portfolio components are not known to us. We have modeled those based on public data as best modeled by CalCCA consultants. We've been using their model extensively for the last year, and the model is a good model. It gave us good direction in the way things materialize, but nevertheless, it's not perfect because it doesn't have the detailed information. So we do the best we can with the publicly available data. That makes our business more challenging to manage, not knowing how PCIA and PG&E generation rate will behave, precisely based on market prices. And also PG&E's portfolio management strategy may change, right? There's a certain level of implied hedges that we derive from public data. We don't know what that level is. They may change, that position may change, will change the outcome. And also the CPUC may change. Ultimately, the rates are approved by the CPUC. They may not approve the rates. They may do things to moderate the rate impact. So there's a lot of uncertainty, and obviously the uncertainty increases further out in time. That's just the nature of risk. While I would not zero in on the absolute value of these numbers, what I would focus on with the stress case is the delta of the stress case scenarios to these, which is very pertinent and very insightful in understanding risks of our business. Okay, so we'll go to the next slide. So here I've summarized it, and there's more details in the appendix, what our projected reserve balance would be on a calendar year basis at the time we did this analysis. So we can see that if scenario 1 were to materialize, prices collapse, we could have 178 million drawn reserves, assuming we stay with our current methodology, rate setting methodology. So we want to be at least a 1% discount to PG&E rates. And scenario 2 is the worst scenario for us. This is basically scenario 1, the 35 million for the additional polar financial reserve requirement. So scenario 2 is essentially 35 million on top of scenario 1. And that's the scenario we're most concerned about, which currently shows that if the prices were to collapse and the collapse happens in 2023, and it sustains, it remains at that low level for the next 5 years, by 2027, we would run out of cash. Okay, so again, this is a risk scenario. I'm not saying this is an expected case. Expected case I showed earlier, which shows very good numbers, but this is a risk that we want to be prepared for. And at the bottom, it shows what the corresponding days cash on hand is. And in this scenario 2, by 2025, we go below our target of holding at least 120 days cash on hand. Okay, we'll go to the next slide. So how do we mitigate the risk? The best mitigation is to hold sufficient financial reserves. Okay, so we want to make sure we have sufficient reserves. When our earlier analysis discussion on investment policy, we want to make sure we have sufficient amount that are in liquid investments that we can tap into should any of these contingencies scenarios were to materialize. So what we'll do, as I mentioned earlier, is we will use the results of, let's say, scenario 2 to recommend to the committee in August, and we'll probably take it to the exec committee in June, what our reserve target level should be. When I gave some examples here. For example, we could target it such that if scenario 2 were to occur, but at least the next 2 years, we don't go below 120 days of cash. Another way would be to say all 5 years, I don't go below 120 days of cash. Another example too here is hold more funds in the near term and hold, which is probably where we're going to go. And this was also a recommendation from the risk committee. And hold less in years, target to hold less for contingencies that can materialize in years 3 to 5. So we may target, for example, as an illustrative example I've shown here is we target 122 days under the stress condition scenario 2 and 60 days over 3 to 5 years. And the reasoning being is that in 3 to 5 years, there's more time for us to react. There's more time for us to think through our business model. And of course, the stress case is something we're going to update every year. So we'll have insights into how our financial projections are changing or could change each year. So we'll have time to react to that. So we will bring this discussion back to the committee on what we recommend based on a scenario 2 stress case. Then that once we target a reserve level, then we'll look at what our expected reserves are, and should there be room above the minimum required, that will then dictate how much we can pass along as additional customer discount or provide additional funding for decarbonization programs. The other risk mitigation strategy, something that we are doing some deep analysis on, is to revisit our current hedging strategy. And this is very complicated, where we could allow loss in revenues to be mitigated by reduction in power supply costs. That means changing our hedging strategy. It's very challenging because one, we don't have insights into PCIA and PG&E generation rates. So that complicates it as to how we can account for that essentially as a position in our portfolio. And then any change in hedging strategy will increase volatility in our power supply cost in our budget. So, but we are doing some deep analysis in this area. And I want to say, I forgot to mention, we have our risk manager on the call here, Karthik Rajan, senior risk manager, who actually did all of these detailed analysis in all these scenarios in a very creative way. So just want to acknowledge his effort and input. And Kevin and Nick Armstrong for the closed session scenario. Sorry, Kevin Armstrong and Nick Zanato. Nick's on vacation. I got the names mixed here. Any questions?
Go ahead, Brian. Or,
I was gonna let you go first.
okay. So I was thinking through what you were saying, Amrit. Right, theoretically, we're in a situation where it's much more likely in the future, or we're certainly going to get in trouble in the future if electricity prices decrease. That provides a big risk. As I mentioned this before, our hedging strategy seemed to be based on prices going up in the future. And so where we are now, I would say we would need to adjust our hedging strategy to lower our percent of purchased for the years out, right? Move the steps down a little bit. But of course, prices could go up on us, but that actually is helpful, right? PCIA goes down. So so what basically where we sit now is, seems like, yes, we definitely want to maybe change our hedging strategy pretty quick. I guess you want to do more deep analysis, but at a high level, I don't think you need to go too deep to know you might want to adjust some. I guess the analysis would be, how much do you adjust?
Yes, that's the key strategy. How much because that's when we need the deep insights into PCIA and PG&E's gen rate, and we're having a lot of brain twisting exercises and trying to understand that impact. And we want to make sure we get it right. And we're having a lot of discussions with CCAA consultant NewGen, make sure we understand their model, because that's a key basis for these analysis.
And I would just add that that's one part of it. The other part of it is, as Amrit mentioned, was what does it do to our supply cost and our exposure at the Cal ISO, and discussions that are going on at the CPUC with respect to the polar, and just a whole lot of other things. So I think it's going to be a discussion between the objective part of it that we can measure from the PCIA and gen rate, plus what we're trying to achieve in other areas as well, and why we hedge.
Plus the risk of, we have to have a certain amount of long-term contracts in place, and they keep canceling on us. That's right.
Well, they don't keep canceling on us.
They keep trying to cancel on us.
Yes, but we have an obligation as a load-serving entity to procure these resources, both from a legislative perspective and also by board direction. So, and for us, those contracts make more sense when we procure them at a fixed price. That's where we get the most value out of them. So that's part of our objective as well.
Okay, Hong Wei.
So if I understand it correctly, the highest risk is we really don't know how PG&E and PCIA set their strategies, and they could change drastically that affect do we have historical data we can go through, or do they know that we depend on their rates so that they would maybe keep us in the loop?
They're not going to keep us in the loop.
Okay.
It's not in their
All right.
interest. I think the history is that CCAs have mentioned that we need more insights into at least PCIA. That should be fair game, and we haven't had much success in that area, let alone their portfolio, which I can understand. They would want to share like we would want to share our portfolio. But PCIA, I would think it should be fair game.
Okay, thank you.
Brian?
Yes, my apologies for being late. Did you do a scenario where what would happen if you were not hedged at all?
So that's some of the back casting we're going to do. That's some of the analysis we want to do to see if we were to change our policy, how we would have fared.
Yeah.
Chances are we would not have done well, as I can tell you, as we have done, because the reason is not from a risk management perspective, it's just the way the market turned out. We are financially long in an uprising market, so we have benefited from this. Had we done what I think we should have done from a risk management perspective, we would have been in a worse position financially than we are, but for the wrong reasons.
Right. So when I worked in Toronto, one of my colleagues went on to become CEO of a gold company, and his strategy was to stop selling their forward gold positions, and in a rising market, they let their revenues just ride right up. And I'll never forget when he made $40 million in a year. And that was back in the early 90s. That was a lot of money back then. It's a lot of money now, but anyways, so choosing what to do is risk management. So you're reducing your variability. You reduce your upside and you reduce your downside. I understand that. The other scenario is when the price collapse occurs, because I'm not sure in the scenarios that you developed, if prices go up and then down, you benefit from the cash that you generated when the prices were going up, and then that softens your downside after if prices do go down. And I mean, you know, you can do all kinds of scenarios, but have you done that one? Because
in essence, that's
go ahead.
In essence, that's what turns out to be the case, because prices right now are quite high, and we continue with the current forward curves till the end of 2022, and then we model 2023 coming down.
Right, but
so we benefit from buildup of reserves. Right now, our reserves are somewhere around 150 million, maybe 158 million. So
right,
we grow it to two on the way we modeled it on the calendar year to 227 million. Actually, with current prices, it would be even higher. And then prices collapse.
And then if the collapse occurs 1 year later or 6 months later, right, things won't look as bad in 2025 as they would if they hang high a little bit longer.
If they hang high a little bit longer, our financial position will be better. Yeah, so we modeled it in 2023. They come down to the 1 percentile level.
Right, it's a stress test. So so you haven't done looking back historically how you would have done or if you had not hedged at all, correct?
Correct. That's one of the analysis we want to do. But as I said, I can tell you directionally what we'll find that we would have done worse off
Yeah.
because our net financial position, not on a physical position basis, net on a financial equivalent basis, we're net long.
Yeah.
And when we're long in a rising market,
Yeah, you're gonna do well.
yeah, and that's what's happened.
And then my final sort of comment would be, if you, or sorry, my question is, SVCE is not regulated by the CPUC at all because we're a government agency.
So our board has the authority to set rates. We don't have to but there's certain regulations we have to comply with, like RPS and resource adequacy. So in that sense, we have to comply with those regulations, polar requirements. But the board has the discretion to set rates and agency policies. So we don't have to follow the current price setting methodology that we choose, but we find that works in our customers' interest.
Amrit, I will add that the CPUC is looking to expand their authority under the Resource Adequacy Program to include a hedging requirement for all load serving entities. And this is a hedge against the whole provider of last resort situation. So while they have not provided, I guess, instructions or guidance or rules around how we can and cannot hedge, this is something that they are very much looking at as part of reliability and resource adequacy. So it's TBD.
Understood. I believe the risk of losing our load base is low. Would you agree with that? What do you think the risks are on our load base? So that would be customers leaving and or customers using less electricity. I only see customers using more electricity. Can you comment on that?
I think that's right. Our participation rate is very high, like something like 96% continues to be high, but the risk is opening of direct access. If the PUC goes back and opens direct access, a lot of our load is CNI, commercial industrial load. There could be exposure there.
Okay. And if we lost load and we're committed to buying power, we would then sell the difference in the spot market?
Or forward market is some market loss.
Okay. But the load isn't going to leave the system. The load would merely leave from SVCE to someone else.
Correct.
Okay. And for commercial customers, who can they get their power from? With direct access, they could get it from anyone. Is that correct?
Correct. Other load serving entities, energy service providers.
Okay. Okay. Sorry for all the questions. I just wanted to.
Good questions.
Are we done with this section now?
Yeah.
So let's check and see if anybody from the public wishes to comment on this. I don't see any raised hands, so then we can close this and now we go to closed session, correct? And then we'll want to come back here after closed session to report out. So we go, I guess we leave and go to the other link now.
I will exit and start the closed session in just a moment.
Regular session again. The committee met in closed sessions to discuss threat to public services or facilities and took no actions that require reporting under the Brown Act. So with that, I will call us adjourned. Thank you, everybody.